What if I told you that the stock market crashing might actually be a good thing? But history shows that some of the biggest money-making moments happen during the worst market crashes. For over 100 years, the stock market has gone through wild ups and downs. From the Great Depression in 1929, the dot-com bubble in 2000, the housing crash in 2008, and even the 2020 pandemic. We've seen it all. But what if I told you that these scary moments taught us powerful lessons? In this video, we're diving into 5 important lessons from past stock market crashes. These are lessons that can help you not just survive, but actually grow your money when times get tough. So grab a snack, sit back, and let's start learning. Lesson 1. Market crashes. Follow patterns. Let's start with the first big lesson. Market crashes follow patterns. Think about watching your favorite movie again and again. After a while, you know exactly what's going to happen. First the problem, then the drama, then the solution. Market crashes are similar. They may look surprising, but if you study history, you'll notice the same signs appear again and again. For example, in 2000, tech companies with no real earnings became too popular. In 2008, banks gave out loans to people who couldn't afford them. And in 2020, the world shut down because of COVID-19. The reasons were different, but the emotions were the same. First excitement, then fear, then panic, and finally, an opportunity for those who were ready. The smart investors, often called the smart money, already know this. They don't wait to be surprised. They watch the signs like rising debt, trade wars, or high inflation. When they see these patterns, they prepare. That's how they stay calm when the crash comes. And that's how they make their next big move. Lesson 2. Crashes create wealth, not just loss. Now let's talk about the second big lesson. Market crashes don't just destroy wealth, they move it. They move money from people who panic to people who are prepared. It's true. Crashes actually create new millionaires. Let's take Warren Buffett, one of the richest and smartest investors in the world. During the 2008 crash, when everyone was scared and selling, Buffett was buying. He bought strong companies for low prices. A few years later, those stocks rose in value, and he made a huge profit. Warren Buffett once said, "Be fearful when others are greedy, and be greedy when others are fearful." What he means is this: when people are excited and rushing to buy stocks, be careful. But when people are scared and selling everything, that's when great deals appear, and that's when he buys. This happened again in 2020. When the market crashed during the pandemic, it dropped fast. In just 1 month, the S&P 500 fell 34%. Many people sold their stocks because they were scared. But some investors, like Buffett, stayed calm. By 2021, the market had recovered and hit new highs. The people who held on, or better yet, who bought more during the dip, made a lot of money. Lesson 3. Your emotions can be dangerous. This brings us to the third lesson. To win in the stock market, you must control your emotions. That's easier said than done. Have you ever eaten junk food while on a diet, even though you knew you shouldn't? Or sent a message to someone you swore you'd ignore? That's emotion winning over logic. The same thing happens when people invest. When the market crashes, our emotional brain takes over. It sees danger and wants to run. It tells us to sell everything and hide. But that's the worst time to sell. In fact, the people who panic and sell often lock in their losses. The people who stay calm and follow a plan are the ones who win in the end. Smart investors know this. They train themselves to stay calm. They remind themselves that crashes are part of the process. They don't let fear make their choices. They understand that the market will recover, just like it has after every crash in the last 100 years. So instead of reacting emotionally, they stay focused, and they grow their money. Lesson 4. Wealth comes from a plan, not luck. Here's a truth that surprises a lot of people. Smart investors don't just get lucky during market crashes. They follow a simple plan, and they follow it all the time. Not just when things are good. That's how they grow their money while others are panicking. The first step in their plan is keeping some extra cash saved. This isn't money they use to buy things or pay bills. It's money they save just for investing when the market drops. They know the market will fall eventually. And when it does, they're ready to buy stocks at cheaper prices. Second, smart investors don't put all their money in at once. Instead, they use something called dollar cost averaging. This means they invest small amounts regularly, like every week or month. So when prices are low, they buy more shares. When prices are high, they still buy, just fewer. Over time, this balances out and helps reduce the risk. The third part of their plan is to diversify. That's a big word, but it just means they don't keep all their eggs in one basket. For example, they don't put all their money in one company, or even in just one type of investment. They spread their money across different things, like technology stocks, energy stocks, real estate, gold, and even bonds. This way, if one part of their investment goes down, the other parts can help protect their total money. But here's what really makes their plan special. They stick to it no matter what. Even when the news is scary, even when everyone else is yelling sell, even when it feels like the world is falling apart. They trust their plan, and that's what keeps them moving forward. While others are acting on emotion, they're following logic. That's how true wealth is built. Not by being lucky, but by staying steady. Lesson 5. Watch for the right signals. Many people ask, how will I know when the market has hit the bottom? The truth is, no one can time it perfectly, not even the experts. But there are signs that help smart investors make better guesses. One of the biggest signs is something called the VIX, also known as the Fear Index. This tool shows how nervous investors are. When the VIX number goes above 30, it usually means people are panicking. And when people panic, prices often fall, sometimes too far. That can be a signal that stocks are cheaper than they should be. Another clue is investor sentiment. This is a fancy way of saying how people feel about the market. When everyone feels negative, scared, and hopeless, that's often when the best buying chances appear. Remember, when everyone is fearful, that's when opportunity knocks. The third signal to watch is what insiders are doing. Insiders are people like CEOs and company leaders. If they start buying shares of their own company, it's a strong sign. Why? Because they know the company better than anyone. They usually only buy when they believe the price is low and the company is going to do well in the future. When you see all three signs, fear, index is high, investor mood is low, and insiders are buying, that's a powerful signal. It doesn't guarantee success, but it tells you the window of opportunity might be opening. Will you be ready? Here's the truth. Every crash in history has ended, every single one. The Great Depression ended, the 2008 crash ended, the 2020 crash ended. And not only did the market recover, it grew even stronger afterward. The people who got rich during those crashes didn't just sit around and hope. They studied the signs, they made a plan, and most importantly, they followed that plan when things got tough. So now the question isn't if there will be another crash, because there will be. The question is, will you be ready for it? If you take the time to learn these 5 lessons, if you build a plan and control your emotions, if you watch for the signals and take smart action, then the next crash could be the biggest opportunity of your life. But if you wait until it's too late, if you follow the crowd and panic, you might miss out. So here's what you should do right now. Start learning. Understand how investing works. Make a simple plan. Decide how much you'll invest and how often. Keep some extra cash ready. Don't use it yet. Just be prepared. Watch the market. Pay attention to the signs, not the noise. Stay calm. No matter what happens, stick to your plan. And finally, if you found this video helpful, be sure to hit the like button, subscribe to the channel for more simple financial lessons, and share this with someone who needs to hear it. Let's all be ready for the next big moment and turn panic into possibility. Thanks for watching, and I'll see you in the next video.